Today we're going to talk about how to build a portfolio that can't be destroyed when the market erupts. So, welcome to the channel. Volatility gets blamed for everything in the markets. Losses, stress, broken strategies, shattered confidence. People talk about it like it's a weather event, a sudden storm that comes out of nowhere and punishes innocent portfolios. But volatility isn't random, and it's almost never external. Volatility is a mirror. Markets don't become chaotic until investors do. Most people don't lose because volatility appeared. They lose because they weren't prepared for it when it did. Before we go deeper, do me a favor. If you're into investing, market psychology, or developing a disciplined approach to trading, hit the like button. It helps more people find content like this, and it tells the algorithm this is worth pushing forward. All right, back to the real reason we're here. The quiet before a storm always feels peaceful. Charts are calm, prices drift, strategies work, everything feels predictable. And that quiet is dangerous, not because it hides a threat, but because it changes behavior. When volatility stays low long enough, something subtle happens. We start believing the calm is normal. We convince ourselves the market is rational, stable, mature. And without even noticing, we start reaching. Positions get bigger. Leverage creeps in. Safeguards soften. The system stretches, not because investors are reckless, but because the environment convinces them that risk has disappeared. But risk never disappears. It simply waits. When volatility comes back, everyone reacts at once. Investors who were confident during the calm suddenly become emotional. People sell because other people are selling. They chase safety with behaviors that actually destroy it. Prices swing, not because fundamentals changed, but because psychology did. Benjamin Graham once said the market behaves like a voting machine in the short term. That wasn't philosophy, that was mechanics. Emotion, especially fear, votes faster and louder than logic. There's a part of volatility most investors never think about. Volatility doesn't just move prices, it changes the rules. You may have a sound position, a reasonable thesis, a properly calculated risk, but when volatility spikes, the brokers, the models, the clearing systems all begin adjusting in real time. Margin requirements expand, buying power disappears. Positions that made perfect sense yesterday no longer qualify today. You can be right, directionally, mathematically, fundamentally, and still lose. Not because the market disagreed, but because the system demanded capital at the exact moment volatility removed it. Volatility doesn't just test your strategy, it tests whether your structure can withstand a rulebook being rewritten overnight. Before I traded only my own capital, I managed millions for clients. Nothing teaches humility faster than losing money that isn't yours. My portfolio was balanced, my risk was measured, my positions made sense. But after one volatility spike, I woke up to find everything had changed except the trade itself. Margin requirements had multiplied overnight. There was no discussion, no grace period, only a forced liquidation, executed at irrational prices while the market convulsed. The trades weren't wrong, but the operational terrain shifted faster than I could respond. And just like that, years of accumulated gains evaporated. A painful lesson, but one I never forgot. Most investors misunderstand volatility. They assume volatility is the force that hurts them. But volatility is also the reason opportunity exists. If prices never moved, there would be no return. Volatility isn't a punishment. It's the fee we pay for the possibility of outperformance. The investors who last aren't the ones who avoid volatility, they're the ones whose portfolios are built to withstand it. They treat calm markets not as permission to increase risk, but as time to prepare. Not because they're pessimists, but because experience teaches one undeniable truth. The storm always comes. Survival in volatile markets isn't about prediction, it's about preparation. So before entering a trade, ask yourself, if volatility doubled tomorrow, could I stay in? If it went up fivefold, could I survive? If it went up tenfold, could I breathe? Here's what I watch relentlessly. Leverage, a boost when markets behave, a guillotine when they don't. Margin requirements, they will change without warning, usually when you least expect or can afford it. Option. Selling, options equal leverage. Naked options, maximum leverage. If you can't instantly cover 100 shares per contract, your position is too large. Cash and liquidity. Buffer, liquidity isn't wasted capital. It's insurance against forced decisions. Counterparty risk. Never assume your broker will function perfectly in a crisis. If you couldn't trade for a day, would your positions survive? Plan ahead. Stress test your portfolio and yourself before volatility forces the issue. Emotional preparation is as important as mathematical preparation. Volatility isn't something to fear. It's something to respect. It separates strategy from impulse. It rewards patience and destroys fragility. Markets rarely test your intelligence. They test your temperament. So, build your shelter before the storm. Trade with humility. And never confuse calm markets with safe markets. Because volatility will return. And when it does, your greatest advantage will be the ability to stay grounded while others unravel. Or as Rudyard Kipling wrote, if you can keep your head when all about you are losing theirs, then time and volatility will work for you, not against you. If this perspective helped you think differently about risk and behavior in markets, consider subscribing and hit the like button. It genuinely makes a difference. And if you want deeper insights, written breakdowns, and premium investing research, check out our Substack. The link will be in the description. Thanks for watching, and remember, the storm always comes, the prepared survive it.